Investing in debt funds has been marked with volatility over the last 2 to 3 years. For many investors, the impact of rising interest rates on the returns of debt funds have made them view these funds with a certain degree of cynicism. The Reserve Bank of India has already hiked the repo rate, and that's the rate at which it lends money to commercial banks, by 250 basis points since May 2022. Now, as interest rates move up, bond yields follow suit and the bond prices fall. And that results in the rising interest rate scenario where many debt funds with bond holdings are seeing with their net asset values feeling the heat. Now, despite the prevailing air of skepticism, experts think that the silver lining is around the corner. With the fiscal deficit number and government borrowing being in line with the recently presented Union Budget 2023-24, this can augur well for bonds and mutual funds. For the investor community, though, this optimism may be hard to come by given the recent spate of volatilities in the arena of debt funds. So, to throw more light on the current landscape of investing in debt funds in India, Aditya Birla Sun Life Mutual Fund Limited is hosting a special presentation where we will explore many things there are to know about debt funds. I'm your host Gautam Srinivasan, and joining me for this conversation is Kaustubh Gupta, who's the co-head of fixed income at Aditya Birla Sun Life AMC Limited. Kaustubh, great to have you come in and provide your expertise on the topic. Let's start with where you see interest rates leading to, and how do you perceive rate cycles following RBI's Feb 2023 meeting, and how do you see it affecting common debt investors?
Thank you, Gautam, for the opportunity. Yeah, so you rightly said out, I think that in last 12 months, most of the central bankers across the globe, they have been running away in a race for increasing rate, and which is probably they are trying to normalize what has been the extraordinary amount of stimulus which was induced as a part of COVID policy. Now, of course, the real reason is that inflation worldwide has surprised these policymakers on the higher side, and which is why these steep rate hikes are in offering. As we speak, in our view, we are very near to the terminal rates for most of the markets, whether it's US or India. So for India specifically, we think that probably RBI will hike maybe another 25 basis point in April policy, which should be the terminal rate for this cycle. But beyond the rate hikes, I think what will drive the interest rates markets and fixed income portfolio particularly will be what's the stance of policymakers on the liquidity. I think incrementally, the up move in rates, if at all it has to happen, it will be more because of the liquidity which is already fleeting. And as liquidity normalize, I think there will be a pressure on interest rates still, at least on the longer end side of the bond, to move higher. As far as shorter end of the curve is concerned, we think they are appropriately moved up. Most of the curve, at least in 1 to 3 years, they are now yielding closer to 8%, which in spite of things that likely inflation to be in the range of 5.5 to 6 for next 1 to 3 years, we think there's a reasonable yield which is an offering for the investors.
All right. Judging by the interest rate scenario that you've just painted, as I asked you, what does it mean for the average investor who's invested into debt funds?
So look, post-COVID, debt funds were never a investable proposition because extraordinary stimulus were introduced and nominal rates they were brought down extraordinary on the cyclical lows. Now, as we speak, these risk-free rates or perceived AAA and yield curves, they are at 8%. So any investors who have an investment horizon between 3, 6, 9, 12 months or maybe more, what he can expect reasonably is that these debt funds are likely to offer closer to 8% anywhere between 1 to 3 year of investment horizon, which is a very reasonable risk-free rate given that the other risk as class assets, they have a lot more volatilities to deal with, both at a local and at a global level.
All right. Now, as per monthly data released by the Association of Mutual Funds in India, or AMFI, debt funds, they saw net outflows of 10,316 crore rupees in January 2023. So what are your thoughts on that?
So two things. Usually in the last quarter of any financial year, the demand for the money goes up, and most of the time we have seen the history. The debt funds, they do lose money during the last quarter because the corporates and other investors, they have other needs which need to fulfill, so they dip into the savings rather than borrowing part of it. And the second thing is that, as I told you, is that incrementally liquidity is getting tighter, and which is pushing a lot of savers to dip into their savings mode to meet out their commitments and requirements, and which is why in our view there is nothing abnormal in these 10,000 crore of outflows. Usually in Jan, Feb, March, these debt funds, they do reduce, see a drawback in terms of overall AUM. But once we cross March, we think that debt funds will see huge amount of inflows because of the attractiveness that they are in.
All right. You mentioned that, and there is an expectation of a rate hike coming in of around 25 basis points. After
Yes.
that, it's left to see. And considering for the central bank, it's always a game of playing catch up or moving ahead at a faster pace. RBI, though, it seems to be cautious about inflation numbers. So your thoughts on RBI's stance going forward from here on?
So it's like the policy response has turned little bit asymmetric towards inflation now. So post global financial crisis, if you look at a global level, policymakers are more concerned for growth, but in last 12 months and incrementally probably for next 2 to 3 years, in our view, policymakers will be more concerned for inflation coming off rather than getting concerned for the growth. Same is true for India as well. I think incremental growth data looks reasonably okay, although we are lower than 6%. But given the circumstances and the what's happening around the world and the uncertainties that we are living in, these are all right growth numbers. But to secure financial stability, even the RBI will want to make sure that the inflation doesn't exceed their target of 4 to 6%, which is why, in our view, the policy response will be more focused on inflation rather than growth. Our view on inflation number for next fiscal year is closer to 5.5, which is somewhat higher than RBI estimate of 5.3. But I think the most of the market consensus is in this range of 5 to 5.5. So it is neither too hot nor too cold.
All right. The expectation of the policy stance being focused more on inflation rather than promoting
Yes.
growth at this point in time. That's the message coming in. I also want to get your thoughts, Kaustubh, on target maturity funds since they have recently gained popularity. Could you
Yeah.
share some more insight on its mechanism and why are they a good option for investors?
Look, target maturity funds, they are open-ended passive funds in a sense that the underlying portfolio of these funds, they mimic the underlying index, which is well published on our website, and it is published on the NSE or any other index maker whose index is the underlying for it. Now the idea is that because these index funds, they are roll downs and they specifically invest mostly in GSEC and sovereign, which is GSEC and SDL. Any inflows onto these funds, we try to mimic the underlying index, and whatever is these underlying index is likely to move on for next till the maturity. The investor can expect the returns which will be in line with the movement in the underlying index as well. Now, if you see historically, we have not been a big proponent of passive funds, but post-COVID, we thought that target maturity funds are likely to be the new area of investments from a risk-adjusted basis. They will be then better opportunities for the investor, which is why temporary over the last 2 years, we have generally advised investors to stick to target maturity funds rather than investing in active funds. But as we speak, the spreads, specifically corporate spreads, which were too low in light of abundant liquidity, they have started normalizing. And if you have to play these corporate spreads, probably the active funds, they make a lot more sense compared to the target maturity funds. Which is why, in my view, from a risk-adjusted basis, active funds will make more sense incrementally for the investors compared to the target maturity funds on one hand. On the other hand, for the traditional investors who are looking for a investment vehicle in debt funds with a very clarity on what kind of duration that we can run, what kind of clarity on what kind of papers that we can buy, or which is a substitute to the traditional source of investment avenues like fixed deposits, then these target maturity funds, I think, is a structural change that we are seeing. There are a lot of tractions from HNIs, retails and corporate investors category, which we have seen in last 12 to 15 months who are using these target maturity funds specifically as an alternative to these traditional source of avenues. So that's continues, but as an active fund manager call, in my view, probably the active funds are likely to do well compared to target maturity funds for next 1 to 2 years.
All right, just to follow up on a point that you mentioned earlier about them being open-ended. From an investor perspective, how can investors be assured of their yields when they say invest in it and hold them till maturity? If you could clarify that point.
Yes. So look, the idea is that target maturity funds is going to mimic an underlying index. These index are traded on day-to-day basis, and whenever any investor is coming as an inflow into these funds, the money manager is going to deploy that money in line with that underlying index. Now, because these are very liquid papers, they don't have large market impact for both inflows and outflows. So the likely investment will be made in line with the YTM of underlying index. And if the investor stays in these target maturity funds till the maturity of that fund, then what he can expect with a reasonable, I would say, probability that the underlying index adjusted for expense is the likely return that he is going to get, unless the money manager is having large tracking error. As a risk mitigation practice, we do track these tracking errors very closely, and SEBI has also come out with the tracking error appetite. If there is any significant deviation from the underlying index, it gets immediately highlighted to our risk and investment committee, and the immediate actions to bring that tracking error into within the confidence level of interval is taken. So in a way, if investors are coming and they are staying till the maturity of fund, in my view, the probability that what investors will get will be the underlying yield of that index fund adjusted for expense is very, very high.
All right, Kaustubh, I also want to get your view on the fact that many funds have subscribed to long-term floating rate GSECs in their ultra short-term funds. So do you think it's a good strategy?
Look, the idea for floating rate bonds that you're talking about is to benefit from the up move in rate cycle, because they have this clause of getting reset with the changing interest rate scenarios on a regular interval. So if there is a move in interest rate cycles, the perceived duration for these papers is significantly lower, and they get benefited with the up move in rates. But at the same time, because if the exposure is to very long tenure floating rate bonds, and if they are lying in ultra short term fund, I think there is a disconnect to some extent. When investors come to us in ultra short term funds, their investment horizon is generally between 3 months to 6 months. But the duration or the volatility which is associated with these very long term floating rate paper is significantly higher because of the spread risk that these underlying papers carries. Now, what is the spread risk? For example, 15-year Gavi floating rate bond will have two element of interest rates. One, which is a floating interest rate, which is 6 months T-bill, which get reset every 6 months, plus a spread, which is fixed for entire 15 years. Now, this spread is also exposed to the mark-to-market movement. For instance, at the inception, if I have logged it at 6 month T-bill plus 100 basis points, it may happen that 6 months down the line, that 100 basis point new normal for the market is not 100, but maybe 150 basis points. So that exposes my investors to significant amount of walls for movement of 100 basis to 150 basis points. So in our view, they are good papers, but having a large exposure in ultra short term funds exposes investors to extraordinary amount of volatility risk, which one should be very much aware of. And which is why as a fund house, we do have exposure to these papers, but not in ultra short term funds, but in a long duration funds categories or corporate bond fund categories or banking PSU funds categories. Investor investment horizon is not 3 to 6 months, but longer, which is closer to 3 years. The second thing is that if we are of the view that interest rates are near to peak or they are likely to peak in next 6 to 12 months also, like these papers, they do have tailwinds when interest rates go up. They are likely to have headwinds when interest rates cycles, they move down. So one need to be look to these exposures from an active time frame rather than a passive strategies.
All right. Any additional advice that you would offer to investors who want to invest in long-term GSEC funds to lock in high interest rates?
Now, in our view, at least the longer end of the curve is not actually get reset higher as what short end of the curve has moved on. Just to give you an example, the short end of the curve has moved higher by approximate 250 to 300 basis point, which is up to 3 year in last 1 year. But the longer end of the curve has just reset higher by about closer to 140, 150 basis points. In our view, as liquidity gets dried up, as central banks continue to keep rates higher for longer, these long end point of the curves, they can still move higher by 40 to 50 basis points minimum, and which is why for now we would advise investors to look to 1 to 3 year points of the curve, which are fairly risk adjusted better place compared to long end GSEC curve that you are talking about.
All right, Kaustubh, before we let you go, could you share some more insights on, what constant maturity funds are and how can investors choose between target maturity funds and constant maturity funds?
Okay, so like target maturity funds, they are open-ended FMPs, to put it simplistically. The constant maturity funds are good for investors who have very long time frame, who want or who don't want to expose themselves to any kind of reinvestment risk, who are looking for increasing duration on fixed income on a consistent basis. Now, when will investor look for it? I think when investors are of the view that structurally rates are moving lower, which means that it is not a period of 1 year, 2 year, but maybe in a time frame of 5 to 10 years or maybe longer, interest rates are moving lower within cycles as well. That's where the investor should look to lock in funds into constant maturity funds. Given that we are emerging markets and we are susceptible to lot of global walls apart from the political walls or the local walls that we get exposed to from time to time, in our view, target maturity funds, they are likely to be a better revenue compared to that constant maturity funds from a fixed income perspective for the investors. But if you are looking for very large allocation in debt without any reinvestment risk, the constant maturity funds can be looked as an option.
All right. And as a summary note, what message would you share with our viewers on the road ahead for debt funds? Of all the talking points that you have listed to us, what are the key takeaways for them as they watch this presentation?
So the point is that in last 3 years, specifically post-COVID, fixed income was never a great investment vehicle because nominal yields were too low. Today, the nominal yields, they have risen quite a lot as policy has been normalized, and they are likely to stay higher for longer, which is next 2, 3, 5 years in our view, and which is why we think that on a risk adjusted basis, as a macro asset class, this asset class today is giving you best risk adjusted returns compared to other asset class. So in our view, it's time to be overweight on fixed income compared to the other asset class. Per se, in last 2-3 years, other asset class, they tend to do well, and we have also advised our investors to go a little underweight on that. I think the time to change that horizon has come in. So investors should look fixed income as a credible investment proposition for next 3 to 5 years in their investment horizon, and they are likely to get benefit from this normalization in interest rate cycles that we are in.
All right. On that note, we bring this special conversation to a close. I hope our viewers would now have gained sufficient information about debt funds and how they could stand to reap benefits by investing in them. Kaustubh, thank you so much for joining us and sharing with all of us these insights, which help explain so much to our viewers. And of course, thank you to our viewers as well for tuning in. Till next time, this is your host, Gautam Srinivasan, signing off. Have a great day.